You're a man who's been traveling the world. You're a man with $2 trillion in assets under management, $53 trillion under your custody. What are your clients asking you right now?
Yeah, well, there's a lot going on. So it's great, first of all, great to be with you. Great to be here at Milken. This is one of those places where everything comes together from around the world. As you said, I have been traveling, and actually you just hear different things from clients in different places according to where you are. I've been in Europe, I've been in India, I've been in the Middle East. That's all over the course of the past couple of weeks. And I would say the sentiment varies a little bit. We're having to explain. So first of all, there is a signal and noise problem when we talk to our clients internationally. People can't really tell the difference between the tactics and the strategy of what's coming out. You know, what's the difference between tariffs and real trade policy? What does it mean on deregulation? Why are these things happening? And so I think all US CEOs find themselves in this perspective. We were joking about this earlier on, but we kind of have to be a bit explainers in chief first and foremost. So what's actually going on? That's what they're interested in. Now, within those continents, there are different perspectives as well. So in India, there was a lot of conversation about, okay, what are the opportunities for India? What might a trade deal look like? How could India benefit from the opportunities associated with all of this? In Europe, a little bit more, what on earth is going on? Is the US a reliable partner?
Yeah, it's one thing to be confused by what's going on in the US, but are those clients actively, or at least specifically talking about pulling away from the US?
Well, I think some of them are thinking about it. And so in Europe, I would say there's a little bit more of that narrative, less so in the Middle East. The Middle East, a recognition that they're sort of sit in the middle of the world geographically and also geopolitically in some cases. And so they observe what's going on. They take some reaction to it. But at the end of the day, they're interested in long-term relationships. In Europe, I would say there's a little bit more of a reaction against it. Maybe they feel a little bit more that they've been put on the spot, and there are certainly conversations about can they de-risk. Now I'll say, de-risking is a little easier said than done sometimes. There's a reason why the US capital markets are the world's greatest, the most liquid, the dollar supremacy, the Treasury is the risk-free asset, the growth in the United States. It's not so easy to just say, hey, we're out.
Back to the Treasury market, because this is where BNY Mellon is a huge player. BNY is this massive central intermediary. What is the risk? Ultimately, it's not just the liquidity concerns we've seen in the midst of the trade war. It is also what we're going to see in the future as we get closer to that X date. Do you have any concerns around how countries around the world might view the Treasury?
Well, I think we all have to be very realistic about the fact that the Treasury market is one of the world's most important markets, as you said. Yes, liquidity was reduced. The depth at the top of the order book was down probably about 80% or so at one point 2 or 3 weeks ago. Now, that doesn't mean that the market wasn't functioning. It was working really well. We were settling over $20 trillion of treasuries a day, and it was all working. But it was harder to move blocks of risk. Now, it's a complicated problem because, yes, we've got the X date. Yes, a 7% deficit is a significant thing to be running, and at some point that has to be brought under control. That is not a long-term tenable situation. It's got to be brought down to a more manageable number, and so people are looking at that. Now, compounding all of that is the question of, okay, do people still have the faith in the United States and the Treasury market? And that's where I would say, of course, people are talking about it, but there are a lot of things that underpin the US Treasury markets and the confidence, the dollar supremacy, the rule of law, the liquidity, and it's easier said than done to pull away from something like that.
The Treasury Department has been talking about the potential to provide relief for the banking system via the SLR, the supplementary leverage ratio, in order to make Treasury markets function more easily in times of these sorts of stress. Do you think that's necessary? Does there need to be regulatory relief more immediately? And will it fix the problem?
Well, I think it will be helpful is the punchline answer to your question. And Secretary Bessent's been pretty clear about this. He is a supporter of making sure that we have the deepest, most liquid market in the world, in the Treasury market, to benefit the US taxpayer and the US economy. And so the question is, what are all of the things things that can be brought to bear to make that true. And this is a little bit of an extension of what the Secretary Bessent and President Trump have said in terms of the policy. It's a three-legged stool. They have an objective around trade, they have an objective around taxes, and they also have a deregulatory agenda. And what we need is banks and other market participants to be able to fully access the market and to intermediate and keep them liquid in the Treasury market. And I think SLR reform is part of that equation.
Is that liquidity there right now? And I specifically go back to the start of April when you had the big sell-off in financial markets, which a lot of people speculate was tied to a potential gum up in what was going on in fixed income, specifically with Treasuries.
Well, I wouldn't say there was a gum up. The infrastructure was working fine. The rails were in good shape. What there was a lack of buyers, and we had a reduced liquidity in the market for sure.
And that's not the same as, I don't want to get into semantics, but isn't that the gum up? If the buyers aren't there, then what happens?
I think they're two different things.
Yeah.
One is there an actual good operation in the market? Are things functioning properly? If you do a big trade, will it settle? Will it flow through? We've had problems in the past in the markets where that hasn't been true. We didn't have any of those issues this time. This was a question of buyers and sellers coming together in the marketplace, and was there enough liquidity? And it was down a lot, but that's where I think things like SLR reform can be helpful, because we want intermediaries to play a role. Banks have to play an important role in the Treasury market. They used to, but they've been moved out of the Treasury market by rules like the SLR, and we're certainly actively in favor of thinking about that leverage ratio reform as the regulators are now talking about it.
The other problem you brought up was the deficit. Realistically, another part of the agenda here for the White House is the tax reform as well. If you do see some of the president's measures get passed, do you have faith that the deficit has any chance of being anything closer to being closed?
Well, it's going to be important that it ultimately happens. 7% is not a long-term tenable situation to have as a gap. And so we need to see either on the tax side or on, of course, the growth of the economy side. If you have a bigger economy, you can actually collect more taxes, even if taxes are the same level or reduced. And so we want the economy to grow. Growth enables everything else.